Well, the Reserve Bank of India has just released the minutes of its Monetary Policy Committee meeting, which was held earlier this month, where the RBI, or the MPC rather, decided to pause on the rate action, leaving the repo rate unchanged at 6.5% by a unanimous vote and the stance unchanged by a 5:1 majority, with Professor Jayanth Varma voting against the stance of the policy. The minutes of the monetary policy meeting, which have now been released, show that there is an all-round concern when it comes to inflation and the outlook. Even though the projection for this year is for inflation to come down, it will still remain above that mid 4% mark, which the RBI is targeting. Of course, we had Professor Jayanth Varma dissenting on the stance, but as far as the rate action was concerned, there was unanimity. Some concerns expressed by, the external members on growth. The internal members, which is Michael Pathwa and the Reserve Bank of India Governor Shaktikanta Das, also reiterating that, this is just a pause, not a pivot. I am now joined by the external members of RBI's Monetary Policy Committee, Shashanka Bhide, Jayanth Varma and Ashima Goyal, to further understand what went behind, the RBI's action earlier this month to leave the repo rate unchanged. Ashima Goyal and gentlemen, welcome to the show. Ms. Ashima Goyal, let me start with you first, because you said, how we've been reading the monetary policy, action so far is, it is a pause, not a pivot. So the first question to you is, are we not done with the rate hikes? And that is something that you also mentioned in the minutes that have now been released.
Well, the policy is going to be data-based, and we know that there are various uncertainties regarding oil prices, regarding the monsoon. And so to that extent, until we are sure that we are moving towards the target in a sustainable manner, we cannot assure that there will be no further rise in repo rates. It will be data-based. That is why we don't say it is a pause, and that is why we have supported the stance this time of withdrawal of accommodation. But understanding that is that we may not have reached our final repo rate hike.
You said it's necessary to emphasize that this may not be the end of the rate hikes. We're already at 6.5%. Ms. Ashima Goyal, we're in the real interest rate territory, so to speak. What is the kind of peak rates that we're talking about, and when will we see, or, can RBI really provide any certainty, or the MPC for that matter, on when the stance could be shifted?
Well, we have raised repo has risen to 90 basis points by now. And it is because monetary policy acts with the lag, so we want to see its effect on the economy. And if that effect is that inflation falls as the current expectations are, barring any further big shocks, then we should not need to raise repo rates further, because the real rate is positive given our expected inflation path, and it's going to be increasing somewhat because inflation will fall and the repo rate is at 6.5. If inflation falls to 5, then we are 1.5%, the real rate. And that is enough to moderate demand such that you move towards the target inflation.
Well, Professor Jayanth Varma, let me bring you in as well. When you talk about, and I'll come to the stance later, that's an interesting bit. But when you talk about inflation, you said that in the current environment of high inflation, monetary policy does not have the luxury of responding to these growth headwinds, and it's almost axiomatic that monetary policy action can cool, to assume that it can cool inflation only by suppressing demand. Is that what you think, the current action is doing?
Absolutely. Absolutely. I think we have delivered about 315 basis points, and that is already showing its impact on the economy. Demand is slowing down in multiple sectors, and we expect that it will suppress demand even more, and inflation would come down. So that is the difference between a monetary policy approach to inflation and, let's say, a supply side response. So if you cool inflation by, let's say, importing stuff from outside or by subsidizing it, then that cools it without cooling the demand. But monetary policy can't do that, can't affect the supply, it only affects the demand. And the only way to bring inflation down is to reduce the demand. And that would definitely imply at least a growth slowdown. So that is the way monetary policy works.
Dr. Bhide, what is your take as well? I read in your statement that you say, the weak external demand conditions are a concern as far as growth is concerned. Any adverse weather conditions can also provide a downside trajectory to growth. There's worries on the inflation front as well, with what could happen with the monsoons and so on and so forth. You think even the current forecast of about 5.2% is slightly optimistic?
Well, no, I think as we have said, the outlook for growth certainly, I guess is it is faced with the external demand weakness, and I think as far as inflation is concerned, the projections are for an inflation rate below 6%. So I think the concern really is that if the growth also slows down, I guess, and then the inflation rate remains high, I mean, that is certainly not something that is useful. So I guess in that sense, it is it's a sort of cautious approach at this time. As Ashima said, I guess we are looking for data, to determine what the rate actions would be. So I think going forward, the concern is that we do expect the inflation rate to slow down, but I guess we need to make sure that that is the sort of the path that may go forward.
All right, that was the HCL Tech Management, but we've been in conversation with Professor Jayanth Varma, Dr. Ashima Goyal and Dr. Shashanka Bhide on the Monetary Policy Committee meeting minutes. And thank you so much for your patience and for staying on. Dr. Goyal, if I may come back to you, RBI's primary mandate has been controlling inflation, and RBI's, the CPI inflation rather has been above 6% for the better part of the last year, in fact, above 4% for a much larger part than that. Now, there is a criticism that perhaps RBI is not taking that 4% mark seriously because of the leeway with the upper band 2 percentage points higher. What would you as an MPC member say to that kind of a reaction?
The RBI's MOU with the Ministry of Finance was for flexible inflation targeting. So this tolerance band was very well designed and it has worked very well for the country. Last October, we wrote a letter to the government because inflation had exceeded 6% for 3 quarters. And we were looking for examples. And we found that the Bank of England had been writing a letter every month for many, many months. So, and the debate abroad is that you should move towards more flexibility because just one number, you can keep missing it. And especially since we were going through very unusual times, the world as a whole, a once in 100 years pandemic, then a war in Europe. And in such circumstances, you are going to have supply side pressures. And India is especially vulnerable to oil and food prices, all of which were raised because of global geopolitics. So in that situation, I think that our band has worked very well. We hear this often that India is a bright spot in the economy, in the globe. We have much better rates of growth than most countries. And our inflation is in our band now. It's exceeded the band only for 3 quarters. So in such circumstances, to raise rates so high that you kill growth in order to reach 4% is not very wise. It doesn't fit with the inflation targeting mandate. But I would also like to say this, that India is in a good position to have a soft landing in the sense that growth will remain high, but inflation will come down because we've had very good coordination between fiscal and monetary policy. Since many of the shocks were supply side, where fiscal action is more effective, government took a number of steps to cool food inflation, the retail oil prices, and all this has helped maintain inflation in the band. And so a real rate of interest of 1% is not a killer for growth, though it does damp excess demand and overheating. And it uses the expectations channel, which is it signals that nominal rates will be raised more than inflation, real rates will remain positive, and therefore we see that expectations of what inflation will be in the future. We know that markets, for example, are now debating whether, their expectations are 5% for the future. Household inflation expectations have also come down.
Yeah.
If landlords, firms, we see that firms are not raising prices, even though they had some cost shocks earlier, though those are reversed now. So this is because of the inflation targeting regime. More and more people are internalizing that India's inflation is going to be below 6%. Earlier, it used to be in double digits before the inflation target. Yeah.
Okay, Professor Jayanth Varma, quickly, since we're running out of time, I wanted to get in a word on the stance as well. Why is it that you disagree with the current stance of the policy, given the uncertain environment and the governor making it very clear, you can't really sort of give a very clear picture as to what rate action will be taken. This is just a pause, and this pause is only very much for this MPC meeting. It is not a pivot.
Yeah, I agree with all of that. My minutes very clearly say that my disagreement is not on that. My disagreement is essentially about the word withdrawing. When all the accommodation has already been withdrawn, and you have gone back to where the easing cycle started in 2019, you can't use the word withdrawal. If you want to say that, you must say that you're going to tighten. You can't say you're going to withdraw accommodation. All the accommodation that has been done since 2019 has already been withdrawn. You're back to that level. So it is not withdrawal. It's the wrong use of the word withdrawal there. If you want to say that you want to tighten further, fine, go ahead and say that. But I think it is also true that it is not very clear that we will have to tighten. We may not. And I have emphasized the two big risks: the risks to the monsoon, which appears to be a very good chance, very high chance that we might be below normal. And the crude oil scenario has changed since February. So those risks are there, which may need a tightening of monetary policy. But if that's what you have in mind, call it tightening, don't call it withdrawal of accommodation. Accommodation has been fully withdrawn already. And we are already at a high enough rate to cool inflation. We would need to tighten only if we get more inflationary shocks as we go along. And otherwise, this should glide it down to 4% over a period of time.
Unfortunately, Professor Varma, you're the only voice on that dissent on the stance. But, coming back to inflation, you saw the latest UK inflation picture as well. It's back in double digits. And the general sense is that, central banks are not done hiking rates just yet. How long can RBI be an outlier? While you say that we need to watch out for the past, monetary policy action transmitting, but how long can RBI really be an outlier given what's going around us globally?
Well, see, the point is that some of those countries, the inflation is running at 3 to 4 times their target zone, even 5 times target. We are running at 1.5 times target. So to say that we are an outlier because our inflation is far lower relative to target. Our target is 4 and we are running close to 6, which is 1.5 times target. You have countries whose target is 2 and they're running at double digits, which means they're 5 times target. There's just no comparison. They need to tighten a lot more because they're running 4 or 5 times above target. We are running 1.5 times above target. So the tightening that we need to do is far less because we never got to that territory at all.
Okay. Dr. Shashanka Bhide, CPI print in March was a 3-month low. I mean, it is still very much above that 4% mid-mark at 5.6%. But do you think inflationary pressures have moderated or, is this largely because of the base effect? And what about core inflation? I mean, what was the conversation within the MPC regarding core inflation specifically? Because that has remained sticky for a long time.
Yes, and I think the decline in March certainly, I guess, is a sort of interesting decline in the inflation rate because both January and February turned out to be much more than 6%. I think so. The point I think about the core inflation, I think in general, the decline in the inflation rate that we saw in March also has to do with the sort of uneven, rates across commodities in the index. As far as core inflation is concerned, I think, we have seen more than 6% rate in several of those sub-items also. So one explanation that we have understood so far is that the pass-through of the increases, external exogenous increases in prices is still not complete, and that is where I think the caution has been that price pass-through of these exogenous shocks, that should be complete. And I think the items such as household goods and services, for example, are still about 6%. I mean, it's about 7% growth in March as well. So I think the concern is that the cooling down of the pressures from the external shocks, that has to be seen. And what we have, I guess what we have is that the agricultural commodity prices in the international markets, they have cooled down, but there is uncertainty with respect to that. As far as agriculture is concerned, I think there is this now forecast of a normal monsoon for the year, but I think there's still an uncertainty that how it will shape up in the second half of the monsoon. So as far as core inflation is concerned, I think there is a need to be cautious about it. I mean, we certainly would like to see that there's a decline in inflationary pressures across the commodity groups within the core inflation.
All right, Dr. Bhide and Dr. Varma, as well as Professor Varma and Dr. Goyal, do hold your thoughts. We have to take a very short break. Don't go anywhere. We're back in just a moment. Welcome back. We're discussing the minutes of the Monetary Policy Committee meeting, which was held earlier this month, which decided to leave repo rates unchanged at 6.5%. And staying with us now are three external members of the Monetary Policy Committee, Professor Jayanth Varma, Dr. Ashima Goyal, and Dr. Shashanka Bhide. Thank you for staying on. And Dr. Goyal, if I could come back to you, this growth estimate that the RBI has put out at 6.5% for this financial year, when you compare it to some of the other estimates that are out there, seems a little optimistic. What to your mind are some of the downside risks to this figure, and what is the likelihood that we may actually undershoot it?
Yes, so we are seeing some slowdown in high-frequency data, but overall the economy has shown considerable resilience. I say that it is an increasing diversity. So the idea of a soft landing and monetary policy works through reducing demand. So in certain categories where the interest rate is beginning to bite, such as low-income housing, real estate, but overall credit growth remains quite buoyant, but manufacturing is in trouble because of exports. And so we have to see whether, over the last 2-3 years, the economy has shown considerable, we have an advantage even in a global slowdown that our domestic demand, the pent-up demand for services, that, for example, this diversity really shows in the current account deficit. Although manufacturing exports are slowing, we're seeing a large rise in all kinds of service exports because of the cost saving, the example from work from home during the pandemic. So there are strengths in the Indian economy, and we may be able to continue to grow at decent rates despite the global growth, global underperformance. Yeah.
Professor Varma, what is your sense? 6.5% is an optimistic number. Even in your minutes, you say that, on the growth front, there are early warning signs of a possible slowdown, which are visible to a greater extent than in February. And policymakers should be vigilant against overshooting the terminal policy rate and thereby slowing the economy to a greater extent than what is needed. What's your sense? Is the number far too optimistic? Professor Varma, if you could hear me. I think, Professor Varma, you're
there are
removed.
big risks to the growth number.
Yes.
Right? There are big risks to growth, and we have to be vigilant about that. And the issue is that in the context of that, we must be very careful about raising rates. We want to raise rates only to the extent required to cool inflation. You can't have a precautionary dose, of monetary tightening because the growth is fragile, and I think there's no doubt about that. There is fragility in growth, but at the moment, the graver issue is about bringing inflation down. Therefore, we have to focus on inflation and bring that down. And as the inflation glides down towards targets, that's when we would get some headroom to provide some support to the economy. But right now, we don't have that flexibility. Inflation has been running very close to the 6% mark, well above 4%. So right now, the focus has to be on bringing inflation down. And we believe that inflation would come down over the next few quarters. As it comes down, approaches 4%, then we would have the ability to support the economy by taking off some of the monetary restraint that is there.
All right. On that note, Professor Jayanth Varma, Dr. Shashanka Bhide, Dr. Ashima Goyal, thank you very much for your time here with us on CNBC-TV18 to help us understand what went behind the policy making of the Reserve Bank of India in this latest meeting. Thank you very much. On that note, we're going to toss it right back to the HCL Tech press conference where the management is